Let's talk about our back test that returned 12,000% since 2005. We've got very few criteria. We've got our system and we've got DDAP. Those two have to align. We either go balls deep into equities, full on NASDAQ, triple leveraged, or we go balls deep into bonds, triple leveraged TQQQ. That's it. That's the back test, whether it's risk on with DDAP trend in favor or risk off with DDAP trend in favor, we long. Other than that, we sit cash. That's how we get 12,000% return since 2005.
Yes. Now, I think it's also important that we pull up the non-logged return. This is a log chart, obviously, to make things look proportional. If I open the non-log chart, you can see it's fucking astronomical. Okay? This thing goes straight up. This is what the real return looks like against S&P.
S&P looks like a little fucking worm down there.
Yep. Doesn't even exist. Long story short, this is parabolic. This is some Starship type shit. Okay? Now, let's look at Aries on a 5-year return percentage-wise, going back. So, again, Aries, the blue line now. And then the Aries with the red line, it's unleveraged. So, this is leveraged versus unleveraged. Long story short, even Aries unleveraged in the last 5 years outperforms your buy and hold SPY strategy.
The beauty of this is it doesn't matter what time frame you look at. You know, we can look at performance from 2013 to 2016, 2010 to 2014. It's always going to look parabolic, no matter where you look at it. If it looks like it's going up 45 degrees up and to the right on a log chart, it's parabolic on a regular chart at all occasions.
Yes.
This is why we always say it's important. Do not get FOMO. We've been sitting in cash for over a year now, which sucks. It's never happened in the history of our system. But it doesn't matter. We know that when the time comes, we get that 30+% compounded annual growth rate. So we don't give a shit about sitting in cash.
Right. And the big part here that you have to pay attention to is what it actually means to win in the market, right? Because a lot of people are saying, oh, if you take this down, if I were to zoom in on this chart all the way into the middle here, somewhere in the middle, right? And you saw this little blip, okay? Little blip right here. And you say, oh man, this thing drew down. If you just were trading this little zone here, you might think this strategy is broken. I just keep losing money. I keep losing, right? And this is what I'm saying, what it actually means to win. Because in the grand scheme of things, what it actually means to win is simply how long and how durable can you sit through what you're playing. This is what we're playing, okay? So we know, listen, there's going to be short-term drawdowns. The max drawdown on the Aries portfolio going back to 2006 is 50.7%, meaning there's a 50% haircut in there somewhere on your account, right? The max drawdown on the SPY, though, during that period was almost over 55%. So we're still triple leveraged, beating the SPY on a drawdown and total return basis, okay? Now, what does it mean to win? Again, answer that question. Simply put, know what you're doing, know your time horizon, and stick to your fucking guns. No pussying out, no bullshit, okay? You have to prepare your mind, number one, and hold yourself accountable. Make your rules, stick to them, and do not move on fucking emotions, okay? You cannot move on emotions. This is a non-emotional game, cookie cutter, black and white. This says jump, we say how high, and we do it when it says it. That's it. It's really that simple, okay? Most people in the market do not make money because they shorten their time frames, and as you shorten your time frames, the odds become more and more stacked against you, and you are not running a black box on fucking Wall Street, okay? So if you're going to try and trade anything within the day's period, you have to be very precise with what you're doing. And your laptop connection in the Bahamas is not fucking it, all right? You're not getting that direct access that you need to trade that type of market, which is why, again, open your time horizons, increase your odds. Most people aren't long around enough to see the success, given, remember, they say 90% of traders fail. Yeah, well, how many of them fail for 10 years? How many of them fail for 20 years? Or how many of them fail for 1 month? That's the big question, right? How long are you in the game? The longer you're in the game, the bigger the time horizon, the higher your odds are to make money and the higher your odds are of success. And to do this, you have to understand what is going on today. That's what our tools are, and that's what they help you do. DDAP, the system, ultimately all combined give you the radar funds. Ares is the tactical leverage, bonds and equities, balls deep, market radar fund.
It's the 60-40 portfolio on steroids.
Literally. You can I've been around a while and I've not seen anything that remotely can come close to this outside of maybe the Medallion Fund.
Medallion Fund obviously didn't have the drawdowns that our portfolio has, but who gives a shit about drawdowns? It's the end result that matters. As long as you're not drawing down absurd amounts, 90%, 80%, that completely take you out of the game, a drawdown doesn't matter. 15%, 20%, that's all right. The only people that care about those kind of drawdowns are people managing billions of dollars. Do we have billions of dollars? We do not, so we don't give a shit.
Yeah, so your $100 turned into $80, or your 10 grand turned into 8 grand, right? Big deal. Your 100 billion turns into 80 billion. That's a fucking problem. And that's simply why you have to understand the context of portfolio volatility. Low portfolio volatility is great because they say, oh, listen, if I can basically put the stair stepper program together that slowly climbs in a straight line, that I can just add billions to the equation and make a lot of money. Well, you don't have billions. You don't. I don't. You don't. And the people you do, probably don't. So what the hell does that stair stepper portfolio matter to you if you can't utilize it? And just to give you some quick specs here on Ares itself, the average long equity position return is about 26%. Obviously, this is leveraged, 3x. The average bond position return is 14%. Okay. The long equity positions over a 17-year period or 18-year period is 20 long equity positions and 19 long bond positions. So in a total of 39 positions you have to manage over 18 years.
And beauty of this, 241 weeks, almost a full year of this was flat, cash, and we still destroy the market.
So if you want to learn more on what this is or the signals that this gives and when to utilize them or how we utilize them, check out our weather report. These signals are posted in there every day, updated, and we're sitting right now waiting to strike next.